Guys, following my latest video of the top 12 most monopolistic companies all around the world, I wanna release today another video. I wanna talk to you guys about the top 10 companies all around the planet with the most territorial exclusivity. Let's go, guys. Number 10, Credit Corp. Credit Corp is Peru's premier financial services holding company. It controls Banco de Crédito del Perú, BCP, the country's oldest and largest commercial bank. Mi Banco, the leading microfinance provider, Pacifico Insurance, and Prima AFP, pension fund manager. Its master business model hinges on macro decoupling and digital ecosystem dominance. Its super app ecosystem, Yape, has evolved from a simple peer-to-peer payment app into a core economic utility that drives microlending, insurance sales, and merchant point-of-sale systems throughout Peru. Industry-leading NIM operates with a remarkably high net interest margin, NIM, of roughly 6.6%, fueled by an enviable funding mix of structural pricing power over loans. The Yape monetization flywheel. Transactional fee income grew 15.6% year over year, with the Yape app alone now directly generating 17% of the entire group's fee income, while boosting a 65% explosion in revenue per active user. Unprecedented capital returns. Powered by strong domestic macro trends, Credit Corp posted record net incomes such as 2.06 billion Peruvian in Q1 2026, generating an extraordinary return on equity of 21.1%. The financial infrastructure of a nation. Throughout BCP and Mi Banco, Credit Corp controls the clear lion's share of Peruvian corporate, consumer, and microfinance credit markets. The absolute digital monopoly. Yape has surpassed 6.4 million monthly active users, which covers an astonishing 82% of the entire economically active population of Peru. Because low-cost deposits make up nearly 64% of its total funding structure, Credit Corp essentially controls the cheapest pool of capital in Peru. Its monopoly trait is network ubiquity. When nearly every vendor, taxi driver, and large corporation in a country prefers or relies on your proprietary payment rails, it becomes virtually impossible for any competitor to break that territory hold. Number 9, Bancolombia. As Colombia's largest private financial institution, Bancolombia operates a full-service universal banking model spanning retail, corporate banking, asset management, brokerage, and international subsidiaries such as Banismo in Panama, El Salvador, and Guatemala. In recent years, its business model has heavily leaned into digital lifestyle bank. Its standalone digital wallet and platform, Neki, acts as a primary financial engine for millions of unbanked and underbanked Colombians, transforming the bank from a traditional lender into an essential daily utility. Strong structural return demonstrates robust internal capital generation, maintaining a strong common equity tier 1 capital ratio of roughly 12.6%. Market-defined profitability. Its financial profile features excellent cost efficiency with operating profit to risk-weighted assets hovering near a healthy 3.8 to 4.1 range. Asset stability. The bank maintains strong resilience against credit cycles, managing a highly stable non-performing loan ratio of approximately 3.1%. The sovereign gatekeeper, Bancolombia, holds a dominant 25% market share of total assets in the Colombian banking system. It forms an oligopoly with the Sarmiento family controlled Grupo Aval, Banco de Bogotá, Banco de Occidente, and Davivienda. Unbeatable network footprint. Between its physical branch network, extensive network of ATMs, corresponsales bancarios across small towns, and Neki's digital grip on microtransactions, Bancolombia commands an unrivaled territorial infrastructure for a huge portion of the Colombian population and domestic businesses operating entirely outside of the Colombian network is highly impractical, cementing its massive low-cost deposit moat. Number 8. Itaú Unibanco. Itaú is the largest financial institution in Latin America in the Southern Hemisphere. Its business model is a diversified powerhouse covering traditional commercial banking, capital markets, asset management, and a vast insurance network. Itaú focuses intensely on high-value private wealth management and corporate relationships, while aggressively digitalizing its massive retail book. Today, over 90% of all its client transactions occur via digital channels. Global leader in bank efficiency, Itaú achieved an elite record low efficiency ratio of roughly 39% in Brazil, making it one of the leanest large-scale banking operations globally. Massive profitability scaling. Its recurring net income stands well above 41 billion reals, maintaining a stellar return on equity of about 21% on an enormous asset base exceeding 2.8 trillion. Premium underwriting mode. It runs a high equity, quality credit book where over 90-day delinquency rates for personal loans sit nearly 5.1%, significantly outperforming the broader Brazilian market average of 9.3%. Consolidated private scale. Brazil's banking sector is notorious for being heavily concentrated among an oligopoly of 5 dominant players: Itaú, Bradesco, Santander Brazil, and the state-owned Banco do Brasil and Caixa Econômica Federal. Corporate and agricultural gridlock. Itaú commands massive category moats, controlling roughly 20% of the entire Brazilian agricultural credit market and doubling its corporate large business portfolio over the last 7 years. The pure depth of its corporate capital allocation power and private payroll lending networks creates an incredibly high structural barrier for international entrants or younger fintechs attempting to capture premium market share. Number 7. Ping An Insurance. Ping An is a global financial titan that pioneers a unique integrated finance plus health and senior care business model. Instead of operating strictly as a legacy insurer, Ping An is a multi-tier tech ecosystem leveraging online platforms like Ping An Good Doctor and Auto Home as lead generation magnets to cross-sell traditional financial products. It operates on a one customer, multiple accounts, multiple products, and one-stop services philosophy spanning life, property and casualty insurance, banking, and asset management. The ecosystem retention. Ping An maintains an astounding 93% retention rate among customers embedded within its senior care and health ecosystems. Cost efficiency via cross-selling. The core advantage of its integrated model shows in its client acquisition costs, Acquiring an internal customer via cross-selling is roughly 35 to 45% lower than the cost of acquiring a new external customer. Robust growth and profitability. Backed by over 1.3 million sales agents and deep offline networks in 330 Chinese cities, its core life and health business generates strong new business value, growth and resiliency, operating profits. The territorial exclusivity and monopoly-like trades, while China's financial sector features heavy state-owned banking rivals, Ping An's monopoly-like trade lies in its data and the ecosystem captivity of the private retail sector. It serves over 250 million retail customers because it blends healthcare, senior living, automotive tracking, and financial services into a single proprietary pipeline. Switching costs for an individual or family become incredibly painful, given Ping An unmatched territory dominance over China's growing middle-class wealth. At number 6, Life Insurance Corporation of India. Formed in 1956 through the state-enforced consolidation of 245 private insurers, LIC is India's premier public sector life insurance giant. Its business model functions as a massive institutional savings vehicle for the Indian public. It converts small recurring insurance premiums from hundreds of millions of individuals into long-term capital, making LIC the single largest institutional investor in the Indian domestic economy. Unrivaled asset base. LIC managing an gargantuan AUM, asset under management profile exceeding 55 trillion rupees, acting as a structural backbone for the Indian equity and public debt markets. Massive human distribution. Its primary driver is an army of over 1.3 million active trained human insurance agents. This specialized distribution channel penetrates deep into rural India, where digital-first banks cannot easily reach. Profit milestones, driven by its sheer scale, annual net profits comfortably exceeding 40,000 crore rupees. Territory exclusivity and monopoly-like trades. The legacy trust advantage. LIC held an absolute legal monopoly in India until the sector opened to private competition in year 2000. Dominant market share. Despite facing major private competitors like SBI Life or HDFC Life over 2 decades, LIC still captures roughly 60% of the entire Indian life insurance market share. Its ultimate monopoly asset is institutional trust. Most Indian households view an LIC policy as implicitly sovereign-backed, a psychological mode no private player can replicate. Number 5, Sberbank of Russia. Sberbank is Russia's largest banking and financial services institution, with the Russian Ministry of Finance holding a permanent controlling block of 50% plus 1 voting share. It has evolved its business model far beyond the traditional retail banking into the Sberb ecosystem, providing digital commerce, cloud computing, logistics, entertainment, artificial intelligence infrastructure alongside traditional savings accounts. Massive domestic profits. Despite intense Western sanctions and decoupling from Western capital markets, Sberbank generates exceptionally domestic profitability, with annual net profits surging past 1.5 trillion rubles. Internalized investor loyalty. Following the first suspension of its international depository receipts, Sberbank converted foreign holdings to local shares, dramatically expanding its domestic retail investor base and generating high dividend yields for citizens. Unmatched liquidity concentration. It holds roughly half of all personal retail deposits in the country, giving it an incredibly cheap and stable funding base. Territorial exclusivity and monopoly-like trades. Absolute financial sovereignty. Sberbank acts as the primary clearing house and utility provider for the Russian economy. With foreign competitors fully exited from the market, it it enjoys a de facto monopoly over state payrolls, pensions, and large corporate financing, the ultimate too big to fail mode. Because it is explicitly excluded from privatization maneuvers and heavily guarded by the state, Sberbank operates without the fear of traditional market insolvency or hostile domestic takeovers. And number 4, UBS Group. UBS is the undisputed kingpin of Switzerland's financial sector and the world's premier global wealth manager. Following its state-engineered historic acquisition of its chief rival Credit Suisse, UBS's business model pivots heavily toward global wealth management and Swiss retail/corporate banking. It acts as a massive funnel for global ultra high net worth wealth, optimizing capital across asset manager and investment banking segments. Enormous asset inflows. The scale of UBS is jaw-dropping, managing over 4.2 trillion in global invested assets, consistently pulling in tens of billions in net new wealth assets every single quarter. Synergy and cost reduction. Following the Credit Suisse merger, the bank executed a massive cost-saving campaign, aggressively decommissioning hundreds of legacy systems to eliminate duplicate infrastructure and realize over $10 billion in cumulative cost reductions ahead of schedule. The regulatory shield requirements, due to its immense systemic size, Swiss regulators require UBS to aggressively bolster its capital buffer, with proposed common equity ratios scaling towards 14 to 17% to guard against sovereign risk. The total domestic monopolies. Within the borders of Switzerland, the merger of UBS and Credit Suisse essentially eliminated the classic two-pillar system of Swiss investment banking. UBS now commands a colossal concentration of domestic corporate lending, retail savings, and asset custody, impenetrable capital and brand barrier. For global high net worth individuals, the Swiss banking system's historical reputation for stability is synonymous with UBS. A competitor attempting to build a bank capable of handling trillion-dollar capital allocation from scratch would find it impossible to match UBS's structural presence, given it an unprecedented state-sanctioned territory monopoly. Number 3, América Móvil, Telmex. Controlled by billionaire Carlos Slim, América Móvil is the leading telecommunications giant in Latin America. Its business model relies on building and owning heavy physical infrastructure, fiber optic networks, cellular towers, subsea cables to sell mobile, fixed line, internet, and pay TV services. In Mexico, its operation ran through Telmex, fixed line, internet, and Telcel mobile. Infrastructure scale. The company generates predictable, recurring, utility-like revenue from hundreds of millions of subscribers across Latin America. Capital efficiency moving throughout 2026. The company has stabilized its capital expenditure, CapEx, at approximately $7 billion annually, because it has already completed the brunt of its costly 5G frequency purchases. It can convert a higher percentage of revenue directly into free cash flow. Earnings strength demonstrates explosive net income growth during periods of cost optimization, heavily supported by its scale. Territorial exclusivity and monopoly-like trades, the legacy monopoly. Telmex was Mexico's state-owned telephone monopoly before privatization in 1990. The head start gave the company an unbeatable infrastructure advantage. Every competitor essentially has to rent or connect to Slim's network. Persistent market dominance. Despite decades of aggressive antitrust regulations by Mexican authorities trying to break its grip, América Móvil still commands roughly 62% of the total telecom market revenues in Mexico, including over 55% of all mobile lines and over 40% of the fixed internet access. The massive capital expenditure required to lay competing physical cables acts as a near impenetrable barrier to entry. Number 2, Petrobras. Petróleo Brasileiro, or Petrobras, is a Brazilian multinational energy corporation where the Brazilian government holds a controlling stake. It operates an integrated energy model spanning from deep water exploration and production to refining, logistics, and marketing. The pre-salt gold mine. Petrobras possesses world-class expertise in ultra-deep-water drilling. Its massive pre-salt reserves off the coast of Brazil offer incredibly high-quality crude oil with remarkably low production costs. Capex and strategic outlook. Under its 2026 to 2030 business plan, the company has committed to a massive $109 billion investment portfolio, allocating over 60% of its upstream development directly to the lucrative pre-salt fields. Resilient cost structure. The company maintains a highly competitive cash flow break-even point, targeting a Brent equilibrium around $59 a barrel, coupled with strict mandates to manage its gross debt. Territorial exclusivity and monopoly-like trades, legal and geological monopolies. While Brazil formally opened its oil sector to foreign companies in 1997, Petrobras retains a de facto monopoly. It commands nearly 80% of Brazil's refining capacity and controls the primary pipeline and distribution logistics. National champion status. The Brazilian state utilizes Petrobras as a tool for economic development. New entrants face immense capital barriers and complex regulatory frameworks, ensuring Petrobras faces no true domestic threat to its supremacy. And guys, we got to number 1, Tencent Holdings. Tencent is a Chinese digital titan whose business model revolves around a super app ecosystem. Its crown jewel, WeChat, is not just a messaging app. It acts as a digital operating system for life in China, creating social networking, payments, e-commerce, gaming, and cloud services. Tencent monetizes through online gaming, value-added social services, digital advertising, and fintech fees. Fundamentals and financials highlights. High-margin ecosystem. Because WeChat acts as the primary gateway to the Chinese internet, Tencent enjoys exceptionally low customer acquisition costs and high user stickiness. Investment powerhouse. Tencent functions almost like a venture capital firm, holding massive stakes in global gaming studios like Epic Games and Riot Games, and domestic tech firms. Financial profile. Characterized by robust cash flow generation and stable, high operating margins driven by its dominant gaming portfolio and digital payment processing fee. Territorial exclusivity and monopoly-like trades. The ultimate network effect. WeChat has well over 1 billion users. In China, it is functionally impossible to navigate daily life, business, or payments without it. This creates an airtight domestic monopoly through sheer network effects. Regulatory mode. China's strict internet regulations and the Great Firewall naturally shield Tencent from direct competition by Western giants like Meta or Google, while it faces domestic rivalry from Alibaba and ByteDance. Tencent completely controls the social and gaming infrastructure. That was it, guys. I hope this was helpful. I hope this gave you some food for thoughts and gave you some insight. As always, do your own due diligence. Don't go and buy a stock blindly. I believe that those stocks, the majority of those, they trade on the OTCM in the United States. Again, do your own research. If you like the company, you can pull the trigger. I appreciate you all watching up until the end. If you got questions, comments, feel free to reach out. I'm here for you guys. Peace out.